Hi, this is a solution to exercise 1010 in the financial management book. In this exercise, we have the income statement, not statement, but budget for 2018, and we have the balance sheet end of 2017. And then we are supposed to draw up the liquidity budget here, and let's start with the first thing. We start with what they call earnings contribution. I prefer to call it profit before depreciation. And we find this in the income statement. It's rather simple. Then we have change in stock, and we find this beginning of the year in the balance sheet here. We find it here. It's the opening balance. And then we have the next one, trade receivables. We find this again in the balance sheet end of 2017. And we have here creditors, it's a liability in the same balance sheet. And then we have to calculate end of the year stock. And we do that by taking here we take our total cost of goods sold and divide by the turnover, and as we can see here, the stock turnover is 6 times. So here we have this, you can see here, it is 28,800 divided by 6. Here we can find the trade receivables because we know that the total sales is 48,000, and we know that the turnover ratio is 10 times, so it is 4,800. You can see it here. And then change in trade creditors, a little bit more complicated because we have to calculate what we have purchased during the budget year. And we have purchased what we are going to use, 28,800, but minus the decrease in stock. You can see the stock decreased by 550, so we don't have to buy all 28. So we deduct these 550 from 28,800, and then we divide by the turnover ratio for creditors. It's 8 times, and then we end up with this 3,531. A decrease in stock, it is a positive liquidity here because it is we don't have so much money tied up in our stock. An increase in trade receivables, it's a minus. It's not good for the liquidity because the customers simply didn't pay us. And here we increased our trade creditors. It's a good thing for our liquidity because we avoid paying them. Then we have other short-term liabilities, minus 200. It was one of the assumptions here, minus 200. And then we have interest costs is from our income statement, 250. And then we have liquidity change for operations. It is a plus of 3,916. Then we have investments, and the investments are in total 1,200. We didn't pay all of it, but we need here to send a signal that the total investment was 1,200. It's of course a minus. And then we here establish a loan on half of the 1,200. So you can find that here. So investment minus 1,200. Then we have repayment of long-term debt. It is according to the assumptions. it is 50 here. So now we have all the figures. If we add all these, we have a total effect on the cash flow during 2018. It's 3,266. And then we can see here that we started with cash 100. So our liquidity beginning of the year is 100, and plus the 3,266, it gives us this liquidity end of the year 3,366. Then we can make our budget end of 2018. And here we have all the figures from end of 2017. And let's try to find the total balance sheet here, end of 18. As you can see, we have here in the beginning a booked value of fixed assets 6,500. We increased this by 1,200 investment, but we have from the income statement we have a depreciation of 2,400, so it is altogether a decrease of 1,200 here. So the new booked value of fixed assets is 5,300. Then we have stocks. We calculated this in the liquidity. We have trade receivables. We calculated this in the liquidity. Other receivables, they are unchanged. It was 300. And cash, we found out here in our liquidity budget that it would end up with 3,366. So altogether our total assets are 18,566. Our share capital is unchanged. Our retained earnings, it is the old amount of 6,550 plus profit for the year 2,255. So the new retained earnings is 8,805. With total equity here. Then we have a decrease in long-term debt because we repaid 50. We have the new loan of 600, half of the total investment. Then we have overdraft facility. We haven't changed that. And then we have trade payables. It's 3,531. It's from the liquidity budget. And then we have a decrease in other short-term debt. We repaid 200, so it decreased, of course, by 200. And then we have total liabilities of 18,566. So now we have it's the same amount.